Good morning or good afternoon, depending on what side of the country you're joining us from. Thank you for joining us today. Really excited. Great presentation. We're going to talk about investments, diversification, and duration. Again, thank you for joining us. You go to the next slide, please. I'm Charlie McQueen, President of McQueen Financial Advisors. I want to thank you all for joining us. The reason why we have this here is I really want to share with everyone. I'm excited. We've got our three main business lines, our investment advisory team talking today. We also have our asset liability management team running real busy right now, running all the quarter and day one reports with some great stuff happening there. And our valuation team, value all sorts of things from mortgage servicing rights to investments to banks to credit unions to all sorts of different things, insurance companies. Great group of people I'm very fortunate to work with. And today I'm really excited to have two of them here. On the next slide, you'll see we have two of our great advisors, two senior investment advisors, Alicia Bradley and Kelsey Mulholland. Alicia and Kelsey are two of our longstanding advisors, very, very good at what they do, amazing talent, and I'm really excited to have the two of them spend some time with everyone today. Let's go to the next slide here. If anyone has any questions, a little housekeeping thing, you can move your mouse around and you can hit the Q&A button on the bottom or top of your screen, depending on where it is, and put them in there. Along the way, I'll be moderating the questions, and if something makes sense, we'll interject and talk about it, or we'll save them for the end. Additionally, today's webinar will be recorded and available on our YouTube channel. Please feel free to check it out anytime. There's a link in everyone's emails here, and you can also do a little Google search and we'll find our YouTube channel with all of our past webinars there also. Next slide here. Really excited about the webinar. We're going to skip our economic update we normally do, as we just did an economic update the other day, which I know all of you are seeing in the markets here, a little bit of bouncing around yields, which really gives a discussion on portfolio diversification and duration. Really great timing. I don't think we could have timed this any better, especially a little bounce in yields today. And with that, I'm going to hand the presentation off to Alicia and Kelsey.
All right. Thank you, Charlie. I'll pick it up. So let's first go over the overview of what we're going to cover today. A couple of topics, of course, portfolio diversification is the main theme here. And in particular, we're going to dive into asset classes. We're going to talk about the nuances of some of the different asset classes, when they might make sense and when there's good value in them. Then we're going to talk about portfolio duration, what that is, how to decide on your ideal portfolio duration, and then finish it up with key takeaways and a summary. And then we'll have some time at the end for a question and answer. So if we don't answer your question throughout, we'll get to it at the end as well.
And then from there, we will kick it off. The first thing we're going to talk about is portfolio diversification. And why is it important that we diversify our portfolio? So we have a few bullet point reasons listed here. The first one being to avoid a concentration. We never want to put all of our eggs in one basket, so to speak. So making sure that we have different asset classes in the portfolio because they will act differently. A shift in relative value, part of those different asset classes acting differently. Some asset at any given time, and then that shift in value will change from time to time, where some classes may have value today, they may not have value in 6 months, and vice versa. We want to be able to manage our risk. Some asset classes have different risk parameters than others. So some asset classes being 0% risk weighted and some at 100, we want to make sure that we aren't putting all of the same type of risk into our portfolio. And then finally, to manage our maturity ladder in our portfolio weighted average life. The maturity ladder and the average life are very dependent on the types of securities that we put in there and the final maturities, whether they be from a static maturity or a cash flowing bond.
All right, and then we'll also be talking about how to diversify. So there are a couple of ways here. The first by asset class. Again, we're going to go into a lot more detail in the coming slides on these. But you can also diversify by term. You can target different maturity years in the fixed income that you're purchasing. And then the last point here is by time. What I mean by that is the period of time in which you're investing. For example, if you were to just start a brand new portfolio last year and invest all of the funds in last year's rates, you're going to be stuck with the concentration of securities that are going to act very similar in different rate environments. And that's something we want to avoid. Ideally, we have a diverse range of asset classes, maturity terms, and interest rate environments in which we've made the investments.
And then from there, we will move into our individual asset classes where we will spend the majority of our presentation. The first one we're going to kick it off with is Treasury Bonds. They are the most basic and vanilla of all of the different fixed income securities that we can purchase. A Treasury bond is simply debt issued by the U.S. Treasury. It carries the explicit guarantee of the U.S. government and therefore is 0% risk weighted. Treasury bonds typically have a fixed coupon and a final stated maturity. And they're often looked at as the risk-free benchmark used by investors to determine the relative value of other asset classes. So one of the things you'll notice in our investment recommendations is that we give you the spread to the Treasury curve. Sometimes it's noted as a spread to the I curve. We give you that spread in the recommendation so that you can see the bond that we're recommending, how it compares to a Treasury bond. And if it is a Treasury bond, we'll compare it to something else to make sure that there is value in the offering that we're showing you. The graph there on the screen is just a simple Treasury curve as of last week, showing the slope between the short end and the longer end. And that is what we use to value the majority of our bonds.
That curve's looking nice and steep, huh?
I know, we've got at least 100 basis points between the 2 and the 10.
I love it.
Yeah, someone once said that it's a really good-looking yield curve. I believe we've heard that a few times recently.
I believe that was Craig.
It might have been. Yeah. Okay. Thank you. Sorry.
That's okay. The next type here is certificates of deposit, often shortened to just CDs. These are offered by financial institutions and provide a fixed term and coupon rate. I'm sure many of you on the call are familiar with CDs on the issuing side, but they are also an investment that you can make in your investment portfolio. They are considered low risk when purchased within that guarantee threshold of $250,000. Under that threshold, the FDIC or NCOA is guaranteeing the bond. As such, they're 20% risk weighted, so a little bit higher than the Treasury because they don't have that explicit US government guarantee, but they do still have some relative safety there with the FDIC and NCOA insurance. Now, one thing to consider with CDs is that they aren't typically priced off of a spread to the Treasury curve. Like Alicia was just talking about how we show value in other asset classes by the spread to the Treasury. That's because usually those asset classes are priced off of the Treasury. That's the benchmark. CDs act a little differently because their rates are going to be more dependent on institutional, depository, and liquidity needs. So depending on how the liquidity and deposit needs shift overall in the market, that's going to dictate what we're seeing on the CD rate side. On the next slide, we'll see a graph of this. So what we have here is the spread of CDs versus Treasury notes over the last 6 years. I'm going to point out 2 years in particular just to show the difference. Let's look at 2018 first. That's the solid gray line that's kind of right in the middle, positive sloping. So in 2018, if we think back, it was a simpler time. I didn't have a desk in my room. Rates were a little higher. But at that time, CD spreads were much higher to the Treasury because institutions generally needed more liquidity and had more deposit needs. So they were trying to attract those depositors in. If we look at the 5-year column off to the very right, you'll see the gray line is pointed towards the top. And in the table below, the 2018 cell under 5 years has 42 basis points of spread. So we were definitely seeing some relative value in the CD space over the Treasury. Flash forward to today, the 2021 line is the solid green. It's kind of the inverse of what the 2018 line was showing. Right now, liquidity is not an issue for the majority of institutions. We're not trying to attract new depositors in. As such, those CD rates are quite low, and on average in the 5-year space, negative spread to Treasury. That's negative 20 basis points under the comparable Treasury right now. So as you can see, relative value does shift in this space. So it's important to consider a CD yield with a Treasury yield.
Absolutely.
So before you leave this page, I do have a question for the two of you.
Yes.
So we blame low yields on Kelsey having a desk in her bed, in her house or bedroom. Is that what we've learned here?
Yes.
And then is the green for Christmas was the next question. But I think that the real question here is the takeaway from this slide is that CD yields are painfully low and you should not be buying CDs right now. Is that a fair statement?
It's a great takeaway, yes.
Great takeaway. Yep.
Thank you.
So from there, we will move over to U.S. agency bonds, which are about just secondary vanilla as you can get to Treasury notes. A U.S. agency bond is debt issued by a government-sponsored enterprise or a GSE. These bonds carry an implicit guarantee, meaning that they have some degree of risk over Treasury bonds. These bonds are all agency-backed, obviously given by their name, and typically they yield more than a Treasury bond. And I say typically simply because right now, on certain parts of the curve, a Treasury bond is actually yielding more than an agency comparison. So for those of you who have been actively investing, you've noticed we've done a decent amount of Treasury purchases simply because they're yielding more than the corresponding agency bond or equivalent to. They do have a couple of different structures. We've highlighted two of them here to talk about. The first one is a bullet structure. Fixed rate in a final stated maturity, meaning you are getting a coupon of X and it will come due on Y date, no questions asked. And then there's a callable structure. It has a final stated maturity, traditionally has a fixed rate, and there's a lockout period where the bond is not callable and then followed by an optionality period. That lockout period can be anywhere from 3 months. I've seen them as long as 2 years. And then that optionality can also vary from a one-time call to continuously callable. The value in the callable space varies based not only on the term, but on the lockout period and the amount of optionality given and the number of times the bond can be called. So there's some value in the space. It depends on the options we're looking at for the portfolio, the goals we're looking at for the portfolio, and where we think rates are moving in the future. And where we think rates are moving in the future is important is because the more optionality a bond has, the sooner it has the potential to be called if rates were to drop significantly, thus meaning that any principal received back has to be reinvested at a lower rate. So then this page here shows, go ahead, Charlie.
Oh, so I had a question that came in. You can stay here about the other page, but
yeah,
is it normal for spreads to be negative to U.S. Treasuries when buying agencies?
I think the answer to that would be no. I think there are market is so flush with cash right now, and so many people are looking to put money to work that they're just sinking it into the Treasury market. The demand for agency bonds isn't there right now. And the issuers don't have any incentive to issue new ones at a higher yield.
Right. So what you're showing here is this is example, and this chart, I guess, is going to go into that description.
That's exactly what it is. So the green line in all the charts will be the Treasury curve. The brown line is the U.S. agency curve. So we can see that on the shorter end, in the very, very short end, it's below. 1 year to 3 year, it's either on top or slightly above. But then when we hit that 4-year mark, all the way out to the 8-year mark, agency bond yields are below the Treasury curve. So it makes more sense to pick up a Treasury that's 0% risk weighted than an agency bond that's 20% risk weighted.
Thank you. And I do have one other question when you're done with this section.
This is the last slide. So before I switch it over to Kelsey,
okay.
What you got?
Question that came in from Jim here. The agency bonds you're talking about here, which agencies are government-sponsored enterprises or GSEs? Because not all agencies are GSEs, correct?
Correct. There are 4 that are considered GSEs, Federal Home Loan Bank or FHLB, Fannie Mae, FNMA, Freddie Mac, and Federal Farm Credit Bank or FFCB.
Okay. Cool. Hopefully that answers the question. Thank you.
And then Kelsey is going to talk to us about municipal bonds.
All right, so we're getting into the exciting stuff now, everyone. Municipal bonds are debt issued by a U.S. state or local municipality, such as a city, school district, or building authority. It should be noted that a municipal bond doesn't have any type of explicit or implicit guarantee by the US government. They are only relying on the municipality's financial strength. And there's also no guarantee by the state that the municipality is located in. I've heard that kind of false info before, so just to be clear about that. And when it comes to the security of the municipal bonds, there are going to be two types, general obligation and revenue. We'll start on the general obligation side, often just shortened to GO. These bonds are secured by the municipality's full faith and credit and taxing authority. This might sound a little bit like legalese, and that's because it kind of is. This is often what we find in the offering statements on the new issue municipal bonds. But what this is saying is that a general obligation security means that for potential debt service, the municipality does have access to its general funds, its unassigned funds, anything that is not assigned for another use can be used to meet debt service if necessary. That's the full faith and credit part. Now, the second part for taxing authority, this is referring to a municipality's taxing power where they can levy property taxes on properties within the district. I'm sure we are all familiar with property taxes, and the benefit that the GO security has is that the municipality can raise or lower the tax rate in accordance with what they need for their debt service. So it gets a little nuanced here. We come to the limited tax GO versus unlimited tax GO. The difference being on the limited tax, the municipality can increase that tax levy only to the voter approved limits versus the unlimited tax where the municipality can raise their tax levy beyond the voter limits to whatever is needed to meet debt service. So the unlimited tax GO is considered the most secure, typically, of a municipal type. On the contrary, we have revenue. This is the other type of municipal bond. These bonds are only going to be secured by one specific revenue stream. So instead of having access to the municipality's general fund or excess reserves, the indenture of the bond is only going to have access to the identified revenue stream. We often are going to see this type of bond for something like a sewer and water district where the revenue stream is sewer and water service charges. Something like that that's considered more of a necessary service does still have generally a high credit quality versus an extreme example of a parking garage. This could be issued by bond issuance and is supported by parking fees from the garage. So if something goes wrong, if that parking garage doesn't ever get finished, if no one wants to use it, the bondholders are going to be out of luck on that front. So there can be risks involved in the revenue streams. You want to be really sure about what the revenue stream is, how the debt service has performed historically, and does it seem likely to perform well in the future. Between the two of these, the differences in credit risk here puts the GO muni bond at 20% risk weighted and the revenue at 50% risk weighted. Now, the other thing to consider with municipal bonds are the tax status, because we're going to see these issued with 3 different tax statuses. The first we'll talk about is taxable. Interest income on a taxable bond is subject to taxation, and therefore yields are a little bit higher to compensate for that. This is a really good type for credit unions to target because they get the benefit of the higher yield without that tax burden. But this also does sometimes make sense for banks as well, especially if there's a nice spread over the comparable Treasury or agency bond. The other 2 types are both tax exempt. The first is general market tax exempt. That's the section in the middle. In this case, interest income is exempt from taxation, but as a result, yields are quite low on these types of issuances, typically lower than the Treasury yield. This makes sense for high net worth individuals or insurance funds. Investors that are paying a higher tax rate might be interested in these, but typically banks and credit unions, it's not going to make a lot of sense from a yield perspective. The third type here, though, is the bank qualified tax exempt. So this is also, interest income is also exempt from taxation on this type, but it has a special qualification that makes it tax advantaged when purchased by banks. So in those cases, we have a taxable equivalent yield that boosts the yield a little bit, and we would compare that to the Treasury, in which case there can be some spread, although similar to the CDs, that relative value does fluctuate over time. Overall, we really like municipal bonds for the additional yield that they can bring. We just want to be really aware of the credit risks involved, and this actually transitions nicely to this next slide. Yeah, so we definitely want to be aware of credit risk and how to monitor and manage that over time. But as a result, we can benefit from the additional value that these bonds can bring.
I'll go ahead and continue. We're done with munis. I got a couple questions for you.
Sure. This is the last slide on the munis to show value over the Treasury. So again, we've got the solid green line as the Treasury curve compared to the brown line that is the muni curve. We're looking at a taxable curve for reference, and you can see we do have some spread across maturity terms on the taxable muni front.
All right. So to boil down, the simple one is you're getting more yield with taxable munis than treasuries, right?
Yes.
Okay. A couple questions that came in, and one was, how does the risk-weighted impact? How does that comparison to the yield of the Treasury get affected? How do you compare a 0% risk-weighted versus a 20% risk-weighted? And I'll take my stab at this and let the two of you add anything. Is, you know, obviously we want to look at the effect to your capital position and your risk-based capital position. And if you can take and have room to take on additional risk-based capital, we're happy to take them. But it is something we want to make sure that we're getting compensated for that additional level of risk. And let me hand it back to the two of you to add to that.
Yeah, that's what I would say as well, is being compensated for the additional risk is really key. So that's why we compare to other options available whenever we're looking at a new bond.
Okay, perfect. All right, I've got another question. We're going to talk about general issuance and Fed and tapering in a little bit here. I'll save that to the end for fun. So go ahead and continue.
All right, I'll throw it to you, Alicia.
So then we have corporate, which are somewhat similar to municipal bonds because they are credit related. Corporate bonds are debt issued by U.S. corporations. We specifically noted U.S. corporations in there because the BC restrict us to corporate debt that are issued by U.S. companies. Similar to municipal bonds, they are subject to a credit risk and do tend to offer a higher yield than Treasury or agency bonds. That credit risk comes from the fact that corporate bonds, unlike municipal bonds, they have zero taxing power. So they can't go to their purchase base and say, hey, we need more money to cover our debt service coverage. They're limited to the amount of cash, the higher credit rating or higher credit risk. For federal credit unions who can't purchase corporate bonds, we look to bank notes. And a bank note is simply a debt obligation issued at the bank level versus at the holding company level. In terms of value fluctuates not only by industry, but it fluctuates from time to time as well, just like all of the other spaces do. Currently, there's definitely some value in the corporate treasury curve. We can see how the difference between the treasury the longer we go. But again, that value can also be dependent on the specific industry space that you are in.
So a question on corporate bonds and banknotes popped up. The question came in, do you see most credit unions limit banknotes to a % of capital or a % of assets in their investment policy?
more as a percentage of the portfolio. And sometimes that it depends on the institution and what the rest of their balance sheet looks like. But I would say if there's an average, it's somewhere between 30 and 50% and no higher than that.
Cool. Thank you very much.
Mm-hmm.
Next up, we'll be looking at the amortizing securities. So we're talking about mortgage-backed securities and CMOs. We're specifically talking about residential mortgage loans here. So in this space, the mortgage loans are securitized into a bond with a coupon and maturity date. MBS stands for mortgage-backed security. They can also be known as pass-throughs. That's because the structure of these has the principal and interest payments passed through from the borrower to the servicer to the investor. So it's a pass-through security. The CMO stands for collateralized mortgage obligation. These are much more structured. They can be made up of several pass-throughs, and a single CMO can have several tranches in which the cash flow is prioritized depending on how the creator of the bond wants to structure it. So the CMO might make sense for an investor that is trying to target certain type of cash flow or a certain timing of cash flows, but of course nothing is guaranteed, so a lot of analysis is still recommended on these types of securities to see how it might behave in rising and falling rate environments. There are a couple of things to consider with the amortizing securities. We have prepayment risk. So this comes into play as rates are falling. We have the potential for the underlying loans to prepay. The bond investor is then stuck with more cash flows available to invest in a lower rate environment. So that's prepayment risk there. The opposite is also a potential risk, extension risk. If rates are rising, the borrower has less incentive to prepay, so that bond is likely to cash flow slower and extend in the books. The bondholder then doesn't have as much cash flow coming back to them available to invest into the higher rate environment. And then another thing to consider if you're looking at amortizing securities is your loan portfolio. You might want to keep that diversification between the types of loans that you're booking and the types of loans that you're buying in the mortgage-backed security. For example, if you book a lot of 30-year mortgages, maybe you want to avoid the 30-year pass-throughs on the investment side.
Absolutely. And then from there, I will talk a little bit about commercial mortgage-backed securities. So as Kelsey mentioned, all of the bonds that she was talking about were residential mortgages. CMBS is all commercial mortgages. So to a bond, they typically have a coupon maturity date. There are multiple different kinds of CMBS bonds. There is Freddie Mac and Ginnie Mae. The three most common types here are outlined on the page. We have Fannie Mae DUS bonds, which simply from the way that they're structured, the loans have a balloon period at which point they come due. They're typically only one loan and they carry a prepayment penalty to the borrower. So that borrower, when they prepay that loan, all of your principal comes back. They typically have an IO period, which is what makes them a bullet alternative. Freddie Mac has multiple different structures across their platform, with the two most common Treasury bonds. Freddie K bonds are structured like a final stated maturity, anywhere from 5 years to 30 years, with different tranches within one bond. The earlier tranches being the shorter tranches, they are backed by multiple loans, anywhere from 6 to several fixed or floating. And then one of the newer asset classes for Freddie Mac is the FRESB, which is very similar to a Freddie K, smaller. Again, those are structured like a CMO is. FRESB shelf can have multiple different final. These can be fixed, floating, or hybrid. CMBS can be purchased specifically for CRA credit if there is a loan in that pool that fits into your market. You can specifically against that loan, and if allocated, Fannie Mae or Freddie Mac will issue what is called a side letter, stating that you as an investor have an interest in a very particular loan, which then can be used for CRA credit. And like MBS and CMOs, commercial mortgage-backed securities are 20% risk-weighted.
Before we hop into mutual funds for a second, a question that came up was why would CMOs and MBSs only be 20% risk weighted, yet corporate bonds are 100% risk weighted? And is that correct? And the answer, it is correct. Just everyone remember the mortgage-backed securities we're talking about are government agency guaranteed mortgage-backed securities. So we don't have credit risk with those. We do have timing risk, but not credit risk, where a corporate bond is going to have credit risk, and henceforth that's the 100% rating, risk-weighted rating versus the 20%.
Absolutely. And if they were private label MBS, they would then have a significantly higher risk weighting because then there is that credit risk involved.
Perfect. Thank you for adding that.
Absolutely. And then Kelsey is going to talk to us about mutual funds.
All right, so this is the last asset class that we're going to dive into in this part of the webinar. So a mutual fund is a company that pools money from many investors and invests the money into securities, including stocks, bonds, or short-term debt. How this works is that investors buy shares, and each share represents that investor's ownership in the fund and the income that it generates. We also are going to have a net asset value, or NAV. This represents the per share market value, or the price of the share that investors are paying to buy into the fund. So we're going to look at some pros and cons and the risks involved. Now, pros include dividend payments, as the securities that make up the mutual fund are cash flowing or paying coupons. That income is going to pass through to the investors in the fund. Similarly, we have capital gains distributions. If the fund managers are purchasing and selling securities, any gains that are realized are going to pass through to the investors as well. We also have the potential for an increase in that net asset value, or the price per share. That's going to be beneficial to your books if you hold it at a lower cost basis. However, we do have pretty much a matching con for every pro here. Although it pays dividends, those dividends are not guaranteed from the mutual fund. So the return that you're seeing from last month or the last year is not necessarily indicative of how that fund is going to pay out going forward. We also have the potential for that net asset value to decrease. So just as easily as it might go up, it can come down, and that's going to negatively impact your financial statements. Mutual funds also are going to be charging fees because the fund is made up of several securities that are being managed by a fund manager, and that manager is going to be charging fees to compensate for the management time. So that's going to cut into your dividend yield as well. And then finally, bring it back to the mark to market and the net asset value shifts. The accounting treatment on the mutual funds are going to impact your income statement. So you have the risk of a decreasing NAV that's going to affect your financials, flow through to the income statement, potentially to the negative, could be to the positive, but we need to understand the risks on all sides. So those are some pros and cons on the risk side of things. The mutual fund is going to take on the risks of the securities that make it up. This mutual fund is not going to be guaranteed like the mortgage-backed security that has that agency backing. So if a fund is investing in banknotes or municipal bonds, it's going to have the credit risk associated with those bonds. So that still needs to be understood and monitored. It also has the potential to have that prepayment and extension risk if the fund is invested in amortizing securities. So those same risks are coming into play here. And then generally, we've got the interest rate risk that the mutual fund is subject to as bond funds values are likely to go down as interest rates go up.
Any concerns on setting, or is it prudent to set a value at which you would want to get out of your mutual fund if you've recognized any sort of losses?
Well, I think that might very well be part of strategy when using these, because it's important if you're going to get into a mutual fund that does not have a fixed maturity date, you know, that you got to know what your end game is going to be. What's your exit strategy? At some point, you're probably going to want to exit the mutual fund, and you have to be okay with the idea that that might be recognizing a loss based on the shifts in the NAV. So that's a good way to mitigate it, is maybe setting a value up front of, you know, here's my entrance level. If we get down to a certain level, I'm going to exit and mitigate any further losses.
Awesome.
Before we leave mutual funds, is there more here? I'm sorry.
No,
Nope.
that was it.
Yeah, I thought so one time. The one thing I want to remind everyone is when we have a bond we purchase in an investment portfolio, and if interest rates go up, as they have a little bit here, the bond then has an unrealized loss potentially. But if we hold that bond to its maturity, say 2 years from now, we get our par back and we have no unrealized loss. With a mutual fund, they have to mark to market. So it is a realized gain or a loss any month. And so it's something, any day, actually, excuse me, talking about net asset value. So that's one of the benefits. If you do feel that we're in a rising interest rate environment, mutual funds can be very difficult in that time frame versus owning bonds that may dip down in value but come back to par at time of maturity. So, thank you, guys.
Yep.
Back to you.
Absolutely.
Yeah, thank you. That's a good distinction.
That wraps up all of our discussion on mutual funds. And from there, we're going to move into a little bit about. So the first question we want to answer is, what is duration? And it is the measurement of sensitivity to a change in interest rates. It is not weighted average life. In a lot of discussions, I hear duration and average life used interchangeably. However, they're both very different. Your duration takes into account your maturity, your bond yield, your coupon, and its call features to establish that duration number. And then that duration number affects our portfolio weighted average life and the price sensitivity.
All right, so why do we care about duration? First, let's understand how duration works and how it acts. Typically, the higher the duration, the longer the portfolio average life. And then as a consequence, the longer the average life, the higher the price sensitivity. So higher price sensitivity will result in larger shifts in market pricing as the market moves in either direction. So pulling back to what Charlie mentioned, as rates change, those market values on your securities are going to shift month to month from your bond accounting, and certain securities are going to be more sensitive than others depending on the structure. So it's important to understand those distinctions, and from that we want to have an idea of what level of sensitivity we're comfortable with in the portfolio, and then think about it even more holistically with the whole balance sheet. How do we manage it all together?
Absolutely. So then the third part in our duration discussion is the how. So we covered the what it is, we covered why, and the how. So how do we manage that duration? And like Kelsey managed, a holistic balance sheet approach is the best way to look what our balance sheet looks like. We want to look at our loan structure. Do we have a lot of short-term loans or long-term loans, fixed rate loans or floating rate loans? What does our current portfolio structure look like? Same thing, is it a lot of shorter term bonds or a lot of longer term bonds? Do we have a lot of potential for extension? And then what does our liability structure look like? So all three of those things rolling up into that holistic balance sheet management approach. And then once we know what all of those things look like, how do we maintain them? Our maturity ladder, managing our price sensitivity, and then looking at the convexity of the bonds that we're purchasing.
So the first how is the maturity ladder. Just like most of the things we're talking about, the answer is diversification. We need to be diverse in the terms that we're targeting for our bond maturities. We can also do that with a mix of asset classes and a mix of optionality structures or call structures on the bonds. Now, typically, we're going to be targeting a maturity ladder that looks like that bell shape. So the shape on the left, where the black dotted line goes through in a nice upside down U. That's going to be the standard maturity ladder that makes sense for a lot of portfolios because it's going to be generating cash flows each year, allowing you to reinvest each year at that current market rate. That's not necessarily the best option for all institutions or all portfolios. There are other options if you have a certain type of cyclicality in your cash flows or you're expecting a large expense in a couple of years that you want to use the portfolio maturities to supplement. You can structure your ladder to reflect that as well. On the right-hand side is a picture of a more barbell-shaped maturity ladder that focuses cash flows on the short and long term with a dip in the medium term. So that's not one size fits all, but generally that bell-shaped curve is going to be a good place to start on maturity-wise.
And then from there, we move into the price sensitivity. So how much do the price of our bonds fluctuate as interest rates change? So there's a very simple couple of tables there on the graph. And we mostly know that the shorter the bond, the less the price sensitivity, the longer the bond, the higher the price sensitivity. So the little table there on the left looks at a 1% increase in rates, assuming an initial investment of $1 million and that your bond has a very flat 1% coupon, just to make math easy. So as rates move up, your 1-year bond changes 1% in value, and your 10-year bond changes 10% in value. You can see the difference in the market value shift there. Again, simple math using 1% coupons and 1% changes in rates. And the same thing happens inversely when rates decrease versus increase. So a 1-year bond sees a positive 1-year change in rates, thus boosting our market value, while our 10-year bond sees a 10% increase in rates, boosting the market value more. And that simply has to do with the coupon of our bond being more or less in line with the newer coupon if a bond were to be issued on that day versus the day we purchased ours.
All right, and lastly, another way to manage duration is convexity. So besides being a high point word on Scrabble, convexity is going to measure how the duration of a bond changes as interest rates change. We're probably familiar with hearing these next couple terms, negative convexity and positive convexity. What this is referring to are each of those various ways of change. On the negative side, a bond with negative convexity has duration that increases as rates increase. So the sensitivity increases as rates increase. Some examples include those amortizing mortgage-backed securities, bonds that have callable optionality, or bonds that have lower coupon than the current prevailing market rate. On the flip side, we have positive convexity where duration decreases as rates increase. So something like a floating rate bond or a bond that has a higher coupon than the prevailing market rate. And with these two different types, what's going to make sense to each portfolio and each institution, again, it's going to come down to the structure of the balance sheet, the other bonds, the assets and liabilities, and the level of risk that we are comfortable with or targeting. But there are ways to target each type to balance out what the institution needs.
Absolutely. So then how do we best manage all of the different duration components that go into managing your investment portfolio? Would anybody like to take a stab at what word's going to show up on the last slide here?
Get one guess.
Diversification.
Diversification.
We say it all the time, diversifying the holdings in your portfolio is so important. So our key takeaways for today, we want to make sure that we have a diversification amongst our asset classes. It helps to limit the risk in any given sector. We want to make sure that we're diversifying the term in which we're buying these different asset classes, building that maturity ladder up to the needs of your financial institution using both static maturity securities as well as amortizing securities, and then diversifying our risk too amongst all of those different asset classes. We want to make sure that we do look at our balance sheet holistically, so making sure we're looking at our loans, our investments, our liabilities, to pick the appropriate bonds for the portfolio as well as a duration perspective.
That wraps us up. So we'll
Does.
refer to Charlie. How are the questions looking?
First of all, amazing job. Thank you for explaining that. I always like the Scrabble word convexity. It's one of my favorites.
It's a great one, isn't it?
Yeah, it is a great one. And I think it's always a very important thing thinking right now. You know, most of your entire balance sheet of a credit union or bank is negative convexity. Things happen different than you want. Interest rates rise, bonds extend, interest rates fall, bonds pay off. And so making sure that you're modeling the overall convexity of your entire balance sheet. And that's why we do ALM and we look at the effect in rising and falling interest rate environments, the entire balance sheet, but it's just as important or more important in your actual investment portfolio to really understand and look at that. So really, really well spelled out. So thank you very much. A couple questions that popped in here. One, here's the municipal market. Given all the things happening by the federal government and the infrastructure bills and different things that have happened, do you see municipal bond credit improving or staying the same or declining here over the next few years?
I'll take this one. I would say improving. We're actually already seeing some improvements on the credits that we monitor, the issuers that we monitor on our side. So I think with the additional government spending and help that's going to municipalities, it's going to help the credit improvements there.
How many different credits do you review? Does a team review and look at a year or thousands, I'm guessing?
Yes.
There you go. So you're seeing good swath of the world. So
we're seeing, yeah, a good chunk of the market.
Yeah, cool. Thank you. Another question that came in, do you expect to see less bonds being issued with the Fed announcing it will be tapering? And I'll take a stab at that. I think we may see less corporate bonds based off of maybe less buyers of corporate bonds. We might see it slow down, but a lot of the debt issuancing by corporations is because of just low interest rates and for general corporate needs or paying off debt that's maturing and using new debt to fund that. The rest, the agency type debt, I expect would continue issuing because that's as needed and potentially even more issuance of treasuries given the additional large amounts of government spending.
And I was gonna say, I would second that answer. The new treasury issuances are based on a calendar. They do this term on this specific day, and then the dollar amount they issue is based on market needs at that time. And then regarding the MBS and CMO, those MBS issuances are based on the individual mortgage holdings that Fannie Mae, Freddie Mac have in their portfolio that they want to wrap into a securitized product. So as long as people are still refinancing their homes, those loans will flow back into the market to be securitized into a product.
Thank you. All right, another question just popped in. What would be your recommendation for an average life for an investment portfolio for a small community bank?
I think it depends on the rest of the balance sheet. I can't just give a number. It depends on what the rest of the balance sheet looks like. Do they have long deposits or short deposits? Do they hold all 30-year residential mortgages or all short-term commercial loans? It depends on all of those things to determine what the appropriate average life would be.
I'll say that on average for the banks that we manage, we're probably looking around 3 years.
Agreed.
For an average life.
Yeah, so I think that's a great answer, that it really does depend on the structure of the institution. If it's all floating rate loans or all 30-year mortgages, we tend to see extremes a lot of the time,
yeah.
But a good generic rule of thumb would be 3 years. And it is going to be different. I think one of the things that a lot of people are forgetting about is the importance of earnings today. and keeping your cash fully invested. Something really, really important to stay fully invested in. And a lot of this conversation today about understanding duration is being the right duration. Being in cash is not a good solution. Being all in 30-year investments is not a good solution either. You've got to figure out what the right solution is and build that ladder. And I really appreciate the slide that you put together, looking at the shape of portfolios and a nice bell-shaped portfolio, as you spoke about, of giving good liquidity as we go forward on a regular basis. All right, let's see here. That is the one more question here. We've had 5 years of deposit growth in the past year and a half.
What?
Isn't it amazing? And so we've got a lot of cash that's come in. I do think that's going to probably take 4 to 5 years for loans to catch up. So in the meantime, do you have any parting comments you'd want to add about how to invest, what to invest, how often to invest any additional cash people have today?
Yeah, a similar response really to the last question is that I like keeping on top of your cash balance and allocating it towards the investment portfolio when loan volume isn't there, because we can at least lock in some higher returns than what that overnight rate is. And if the maturity ladder is structured well, we're going to be getting the cash flow back for months and months and years to come to be able to take advantage of rates if and when they do rise.
Thank you. All right. With that, I really appreciate, Kelsey, the time and effort you put into this, the information, very logical, well thought out. Thank you. Alicia, the same to you. Thank you for your time and effort and presentation of this. We really appreciate your expertise. Two of you do a wonderful job managing portfolios. We appreciate that, and you're great at what the two of you do. With that, I do want to thank all of you for attending. We're really excited to have everyone here. We do have coming up here on December 1st, a sub-debt presentation. We'll talk about a lot of the explosion in the credit union market of subordinated debt. So a quick one coming up here in just a few weeks. And then after that, we have another December webinar on December 14th, our annual State of the Industry M&A update. So 2 great webinars coming up in December between now and Christmas. So we're excited about that. And for those that have asked, we will have the PowerPoint presentation available. Please reach out to your advisor or reach out to us at the office here, and we will get you a copy. With that, thank you all. I hope everyone has a wonderful day. Thanks, guys.
Thank you.